One stock just cracked today's top 5 for July 9th. BKR. BKR just broke higher after getting absolutely hammered. Down 17.9% from its 52-week high. It looked dead, but today it snapped back hard, up 5.71% on volume. That's nearly double normal. On the surface, that looks bullish. Here's the problem. Every metric you'd normally trust to confirm a reversal is whispering the opposite. Options traders are positioning for a crash. Momentum isn't there, and there's no catalyst behind this bounce, just sentiment. We're looking at a trade, not a conviction. Let's break down what the data actually says. BKR has been crushed since its 52-week peak, and today it's trying to bounce. It's trading at $57.58, above its 200-day moving average at $55.46, which is technically constructive. But here's the thorn. It's still $5.19 below its 50-day moving average at $62.77. That 50-day is the real ceiling for this setup. On the downside, support is locked in at $52.27, so the play is defined. If the bounce holds above $52.27, the stock can target $62.77 and beyond. If it fails here, the floor is $52.27. Volume backing the move is there, 1.93 times normal. So the price action is legitimate, but the trend structure remains broken until it reclaims that 50-day line. The RSI is at 46.02. That's right at the midline, neutral territory, which means this stock isn't overbought or oversold. So the bounce isn't a panic reversal or a blown-out setup. It's a measured move into equilibrium. On paper, that sounds good, but it also means there's zero momentum behind the move. Compare that to a textbook bullish bounce. RSI would be rising from 30, showing energy returning. Here, it's just centered. The technical picture is one of indecision, not conviction. The stock is above its 200-day, which is constructive for structure, but it's fighting hard against the 50-day line. Until it reclaims that, it's still in a downtrend. Neutral RSI plus price below the 50-day equals the bounce is possible, but the trend is still hostile. The catalyst here is slim. Baker Hughes scored a power supply agreement for Kodiak gas, a positive signal for contract flow in the energy sector. That's the bull thesis, and it's real. But here's the catch. There's no earnings date on the calendar to prop this up. This bounce is entirely sentiment driven off a single news item. One sector rotation away from energy, and this trade collapses in minutes. Energy is cyclical, and macro shifts away from energy can reverse instantly. Add that to the fact that BKR is still $5 away from its 50-day line and $7 away from resistance at $65.45. The risk-reward might look good on a chart, but operationally, the stock has no fundamental catalyst to drive it higher from here. Sentiment can evaporate fast. The put-to-call ratio is 1.952. That's very bearish, meaning for every dollar of call options being bought, $1.95 is being spent on puts. Smart money is hedging against a crash, not buying the bounce. That's a flashing warning sign. Meanwhile, implied volatility on the ATM options is 0.3735, which is historically low for Baker Hughes, so options are cheap. That creates a tension. Options are cheap, suggesting misprice or opportunity, but the put-to-call ratio is extreme, suggesting fear. What's this telling you? The crowd is hedging downside protection cheaply. They're not betting on downside, they're buying insurance. That hedging pressure is a major headwind for a sustained rally. It's systematic to risking, the opposite of FOMO. The verdict is watch up with LOW conviction. And that LOW conviction matters more than the up direction. The setup is mechanically sound. Entry at $57.30, $57.58, stop at $54.45, targets up to $74, and a 2.24 to 1 risk-reward ratio that's actually attractive. But the conviction is real and earned. Options traders are hedging downside. Momentum is neutral. There's no catalyst beyond one news item, and the trend is still broken. This is a short-term trade with an unfavorable risk-adjusted edge. If you're nimble and sizing small, 1 to 2% of your account max, you can play it. But this isn't a position to hold through weeks. Take the target hits and exit. Miss it if you need your conviction stories backed by fundamentals. Baker Hughes is at a crossroads, but it's not a compelling buy at current conviction levels. The bounce is real, the technicals are clean, and the risk-reward is there. But the heart of the story, options traders hedging, no fundamental catalyst, sentiment-driven, momentum stalled, means this is a trade window, not an investment thesis. Watch to see if BKR holds above $52.27 support over the next 5 days. If it sticks, the $62.77 50-day moving average is in play and the bounce gains credibility. If it cracks below $52.27, the thesis is dead and you exit the stop. Do your own analysis, respect your position size, and don't let a single day of green erase the structural headwinds. This is a watch, not a conviction.